Howdy, Jacob here. Today we're looking at ticker symbol LEG. So it's in the household durables industry, $3.5 billion market cap with a 5.2 enterprise value. So fair amount of net debt, but having a 6.9% dividend yield, well over the 4% that our screener is looking for. So we're seeing about $2.1 billion long-term debt. They had about 850 in 2012 as per a ratio. Let's see, a 5 year average. We're looking at 341, 170, 540, 520. Let's say maybe a $250 million 5 year average, $300 million. Let's say $300 million. That's that's a good amount of debt. That's almost 7 times their 5 year average free cash flow, and that's with them paying out almost 2/3 or about 2/3 as a payout ratio. That's a fair amount. That's a good amount of debt for a company that is focusing on paying out dividends. It's All lenders are different. Some have payout restrictions based on cash flow, but for this company right now, I wouldn't say it's extremely alarming, but definitely something I want them to start thinking about. They can't just keep issuing debt for acquisitions, which looks like that's what they've been doing. Outside of acquisitions, looks like they've been okay at paying down debt. But yeah, I think we can start getting to some assumptions here. As for the dividend, I'm gonna stick it where it's at right now. I don't want to increase it beyond, as it's already got a very high payout ratio. I would want the company to, if they do keep this dividend, that 30% that they're able, 30 to 35%, they're able to their excess cash flow, focus on paying down debt. It looks like they're also making acquisitions, so maybe their use of funds is kind of 2/3 to dividends, and then like a sixth to acquisitions, a sixth to paying down debt. Then that might be. I mean, the more I talk about it, I think I want to cut this in half because that's still going to be over a third payout. Let's keep it as is. Just until we do a further review, I'm going to keep it as is, because again, the price we get isn't the price that I'm necessarily looking to buy it. It's the price that I'm thinking about doing more research on the company from a high level standpoint. And so I'm going to keep it at the 2/3, 70% payout ratio that it is. That's fine. As for growth in the company, maybe I'll do 2%. And the return on invested capital is actually pretty decent. The last couple of years, 8%, 11%, 7.2%, 10.7%, 12.8%. That is very reasonable, and doesn't it's not big enough to me where I can tell that there's a moat in this business or anything, but it is good to see that the company has good return on invested capital on what it does invest in the business. But again, we already said 70% is going to dividends, so they're not using a lot of that cash flow to get these excess returns, and so it doesn't require as much of a premium on the P and price free cash flow as a company that's reinvesting all of their money to get that insane growth. And as for 6.8, 7.9, does have a lot of debt, so that's true. 6 and 7, 0% on the share change. And honestly, not too far off. So we're looking at 23% drop before you get a 15% return given these assumptions. Again, I said the company might, if they really want to focus on debt, if debt's coming due and their lenders are saying that there's a concern with them being able to afford it, then they might have to cut the dividend to be able to afford paying down as much debt as they can to where the lenders are confident with their leverage ratio. But I don't know. I think even if they cut it in half, this is still a 3.4% dividend yield. It's still a good amount, but there's not so much debt it's concerning. I mean, again, I don't want to overemphasize that. We've seen a lot of companies that it's 10 times debt, 10 times the 5 year average for debt. This is Again, like I said, maybe a little under 7, but it's still not where we want to be, and not confident that a lender is going to be so forthgiving to, or so willing to give up their bill or lend money to the company to be able to do whatever excess things they want to do with it, whether that be make acquisitions, buy back shares, pay dividends. So I think um, I think I'm just gonna be waiting until it gets to a price that's more attractive, and then once it gets closer, I'll do more research on it to really see whether the company's able to afford this dividend and whether these assumptions are appropriate. But again, for now, we're just waiting a little bit. Yeah, I hope everyone has a good rest of their day. Thank you.